Welcome back to the Bitcoin Fortress podcast. This is episode 179, recorded on August 31st, 2025. As always, this is Bitcoin only, no shitcoins, no hype, just the signal. Today, we've got a packed lineup of about 25 different segments covering everything from US government pilots putting macro data on chain to new corporate treasuries in Europe and Asia, miners dealing with tariffs, new Lightning upgrades, and what Bitcoin developers and podcasters have been talking about across the ecosystem. So, with that, let's get started. The U.S. Department of Commerce's Bureau of Economic Analysis kicked off a limited pilot this week that pushes macroeconomic data, things like GDP revisions and inflation components, onto public blockchains using Oracle networks. Reports highlight Chainlink and Pyth as two of the networks involved. For Bitcoiners, this is interesting because it takes traditionally centralized government data and publishes it in a way that it's time-stamped, tamper-evident, and globally visible. Not a CBDC, and it's not Bitcoin itself, but it rhymes with the ethos of verifiability. So imagine being able to prove exactly when a GDP number was released or track revisions transparently without waiting for headlines. This is early, narrow, and experimental, but worth watching as governments explore ways to publish data on chain. Counterpoint: if you don't trust the government's data, which I don't, then they are simply inscribing lies into the blockchain where they will live forever. So that's another way of looking at it. Perhaps a little cynical, but oh well. We'll see what they do going forward with that. Tether announced that it will launch USDT natively on Bitcoin using the RGB protocol. RGB is a client-side validation system that anchors assets to Bitcoin but validates them off-chain, avoiding chain bloat. This matters because stable value rails directly on Bitcoin can increase settlement volume without pushing users to other networks. In practice, this could make it easier for people to send dollars globally, but still leverage Bitcoin infrastructure. There are trade offs. Issuer risk is still issuer risk, but strategically having more liquidity anchored to Bitcoin rails could increase Lightning adoption and strengthen Bitcoin's role as the base layer of global settlement. In Europe, the Amsterdam Bitcoin Treasury Strategy, backed by Amdax, raised about $23 million dollars and announced ambitions to accumulate at least 1% of the total Bitcoin supply over time. The group is working toward a future Euronext listing. Think of this as a European cousin of MicroStrategy, but structured differently and potentially with different disclosure requirements. It's part of a growing wave of public Bitcoin treasury companies that hold Bitcoin on their balance sheet and offer equity as a proxy for investors who can't or won't hold Bitcoin directly. It's another sign that the idea of corporate treasuries holding Bitcoin is not slowing down, it is globalizing. And of course, while adoption is good, it's better for us to hold our Bitcoin in self custody, not on an exchange and not in a equity proxy whenever possible. Reports from Arkham Intelligence and others suggest that a UAE government linked entity has mined and accumulated about 6,300 Bitcoin. While attribution in blockchain analysis should always be taken with caution/skepticism, this is a credible data point that yet another energy rich nation is turning stranded or surplus energy into hash. It's not just buying Bitcoin on market, it's actively mining it. This matters geopolitically. If accurate, it adds to the list of governments that see Bitcoin mining as a strategic capability alongside oil, gas, and renewables. American Bitcoin, or ABTC, a miner turned accumulator, received approval to move forward with a NASDAQ listing. Coverage framed it as a new public, quote, Bitcoin proxy. That means another equity wrapper is entering the market whose net asset value is largely tied to its Bitcoin holdings. Investors will watch how it trades versus spot Bitcoin. Does it hold a premium like MicroStrategy or trade at a discount depending on leverage and governance? For Bitcoiners, the bigger story is the proliferation of public companies whose balance sheet is Bitcoin. That increases both transparency and competition. So we'll see what happens with that one. That's a slightly different spin on the Bitcoin treasury, since it actually the core business is Bitcoin mining, which most of the Bitcoin treasury companies have different types of businesses that are at the core, but they end up getting value basically on the Bitcoin that they're accumulating and how fast they're able to build that up and how cheaply they're able to access capital. MicroStrategy being, of course, the first mover there and probably the best at it of any of them. This week's Bitcoin OpTech report highlighted a major success. Differential fuzzing across Bitcoin and Lightning node implementations uncovered dozens of bugs that are now fixed. At the same time, Lightning DevKit implemented splicing, which lets wallets resize channels without downtime. This matters because bugs are getting fixed before they cause problems in production, which is terrific. And user experience on Lightning improves. With splicing, wallets can automatically manage liquidity in the background, making Lightning just work for users and merchants. It's not flashy, but boring. Incremental development, and that's what keeps Bitcoin reliable. So great to see. And of course, the Lightning Network will continue to evolve and hopefully become a very good payments platform where you can actually pay in Bitcoin and you don't need to worry about exchanging in and out of fiat. Last week, charts showed a sudden spike in hash rate, almost 300 exahash per second, that seemingly appeared overnight. This week, Ocean Pool explained it was a bug in its reporting dashboard. The lesson here is don't overreact to one data source. Look at multiple hash rate trackers and remember that anomalies do happen. But kudos to Ocean for transparency in explaining the glitch quickly. And of course, hash rate's important because that keeps the network secure, and a continually growing hash rate, which is what we've seen over time with the Bitcoin network, is a very, very good thing. Galaxy Research reported that around 15% of daily blocks recently included zero transaction fees, with median fees down more than 80% from 2024 peaks. And so, as a reminder to the listeners, when a miner finds a block, they are given a block reward, which is 3.125 Bitcoin currently. And additionally, transaction fees. And so the transaction fees are added on depending on how congested the network is. And so if the network is highly congested, the transaction fees tend to go up, and then the miners get more money. So this is a challenge for miners in the post-halving world, because again, they were getting more Bitcoin before this last halving event. Was 6.5 Bitcoin. Now it's 3.125. So the subsidy's smaller and fees matter more, or will matter more over time, of course, as the block subsidy continues to get cut in half every 4 years. But right now, activity is muted. Things that have driven past activity like inscriptions on Bitcoin have cooled, and mempools are often thin outside US business hours. But for users, it's still a great time to consolidate your UTXOs, batch transactions, and use SegWit or Taproot. So if you have a lot of little UTXOs, it's always good to consolidate those into larger ones for the future when it comes and transaction fees are higher, uh, and they will be someday. So take advantage of the cheap transaction fees today. Hash rate index reported that fees were only about 0.66% of rewards this week, with hash price down month over month. Again, that means that miners are leaning more heavily on cheap energy deals, firmware optimizations, and even selling hash rate derivatives to lock in revenue. So basically, a hedging activity in order to generate some revenue or lock in revenue uh, uh, to mitigate some of the risk of the future. Luxor reports about 200 million notional of hash rate forward contracts have traded this year, with expectations of several hundred million by year's end. So this definitely seems to be a growing trend. Again, this matters because the miners now have a financial instrument to hedge their revenue, which means less forced selling of Bitcoin during drawdowns. For lenders and counterparties, it's also a way to manage risk exposure. This isn't something for retail investors, it's really for industrial miners, but seems to be an important financial innovation for them to manage their business. And certainly, if it mitigates the risk of or the need for them to have to dump their Bitcoin that they're holding on their balance sheet in order to generate liquidity, well, that's probably a good thing for the overall market since a lot of the selling historically has come from the miners. That's kind of the most steady source of supply to the market because they need to generate cash in order to run their operations. New import duties on Asian managed manufactured ASICs are hitting miners with effective rates between 20% and 57%, potentially adding nine figures of cost. In the short term, miners may delay expansions or pay premiums for used or domestic rigs, but in the medium term, I think we can expect a push toward onshore manufacturing of these mining rigs. Reports suggest that Bitmain and MicroBT are already exploring US based assembly as a workaround. This does, however, add pressure to diversify sourcing and also rethink supply chains in mining. Law enforcement agencies, including the Department of Justice and Europol, announced the dismantling of Verif Tools, a marketplace used in many crypto phishing and malware attacks. For Bitcoiners, this is a reminder phishing evolves constantly. Uh, First of all, always verify whoever is reaching out to you. Usually, customer support doesn't reach out to you out of the blue with a text message from not your country. So that's usually a red flag. Always test with a tiny send first to make sure that the address works, and use address allow lists and verify that software sources with PGP signatures where possible. In Florida, a ringleader in a home invasion robbery targeting Bitcoin was sentenced to extra time. The lesson here, do not, and we've talked about this the last few weeks, I think, do not broadcast your Bitcoin wealth publicly, even subtly. So as much as you want to wear that Bitcoin hat or that Bitcoin shirt, that's fine at a conference, but maybe you don't want to do that every day. And you certainly don't want people to know that you have Bitcoin because you're just going to open yourself up to be a target. Also using multi-sig, two of three, three of five signatures, with the keys geographically distributed is probably not a bad idea. You can also put time delays. You can also create decoys. You can have a decoy wallet, and other things. And of course, probably the most important thing as far as OPSEC goes is educating your family members, since attackers will often target your loved ones. So make sure that they're on the program too and understand how to keep everything private and confidential as it should be. In a separate Florida case, a judge ordered seized Bitcoin returned to its rightful owner. So, this is a positive legal precedent, since courts are now becoming more literate about digital property and recognizing that possession of keys isn't the same as legal ownership. And I haven't really talked about this much here, but it is important to have your Bitcoin properly legally titled. If you're owning it in your own name, that's fine. You just open up a wallet and there you go. But if you want to, for example, pass it on to the next generation, you're going to need to create a wallet that's titled under your revocable trust, let's say. Or if you actually want to gift it to your kids, you would need an irrevocable trust set up. And you probably want to do multi-sig, and you probably want to set up a vault with, a Bitcoin only company, so that it's all tidy from a legal standpoint. And then the key management is also taken care of as well. And you want to make sure that you leave instructions and all that for your trustee or whoever your executor is, so that they know how to get the keys. Not necessarily the keys themselves. You don't want to put that in any documents, but certainly where to find them and how to get that to your next of kin is really important. So a lot of stuff to think about there as it relates to legal ownership. But again, for holders, it's a reminder: keep the records clean on where you got the coins from and how you're holding them, in case you ever have to defend your ownership in a court of law. A Pennsylvania bill advanced this week that would bar state and county officials from holding digital assets, citing conflict of interest concerns. So, this raises important questions about financial discrimination. If officials are banned from owning lawful property, does that silence knowledgeable voices in the government? It's probably worth watching whether this bill stalls or spreads. I mean, if they're going to do that, why don't they just tell the Congress people that they can no longer buy stocks? And then we won't have to worry about them front running the market and being better traders than Warren Buffett. I mean, it's just kind of ridiculous. Plus, I mean, you should be able to, I mean, you should have property rights, but then you should also not be able to front run the market. So, how to make that happen in practice, I don't have all the answers. I don't have any answers, but I do think that it's probably a little bit of an overreach to say, sorry, you can't buy Bitcoin. Over 100 organizations have signed a letter urging Congress to protect open source developers from strict liability for the code they publish. This matters for Bitcoin because every node, wallet, and miner software package is open source software. The principle that code is speech is vital for the health of the ecosystem. And of course, bad behavior needs to be punished, but let's not punish the good guys for creating open source software that can help ensure our freedom and liberty and prosperity. The Bitcoin Asia 2025 conference is in Hong Kong, featured some strong pro Bitcoin messaging and showcased new Lightning and Treasury initiatives. The takeaway: Asia is increasingly important in shaping Bitcoin's future, both on the policy side and in adoption. And again, I'm going to put links in the show notes to all these articles so you can read it for yourself in more detail. A federal investor lawsuit against MicroStrategy was dismissed this week. This removes one overhang for the pioneering corporate Bitcoin treasury company and reinforces the legitimacy of their strategy. It also signals to other firms that courts are unlikely to punish companies simply for holding Bitcoin, provided disclosures are sound. So, uh, hats off to MicroStrategy. And of course, I wouldn't choose to invest in that company right now. I'd rather just hold my investment in Bitcoin and cold storage. But for some people, it's fun to trade their options. You can make a little bit of money. You might not be able to access Bitcoin in your brokerage account. You might not even have access to Bitcoin ETFs. You might want to earn a little higher return. So, to each their own, as far as whether or not they want to buy something like that. But I guess if you're messing around with Bitcoin treasury companies, it's probably best to go with the granddaddy as opposed to a lot of the newer ones, because who knows how they're going to pan out. Looping back to our first segment, one of the most important features of on-chain government data is time-stamped releases. So for markets, that reduces rumor volatility. For Bitcoiners, it's another proof point for the idea that time-stamped verifiable records are superior to opaque manipulable systems. And so I guess that is a positive, right? So even if they're publishing their fake data, once it's time stamped onto the chain, it can't be changed. So you can't go back and manipulate it. Um, Although they do constantly revise their numbers, so they'll post it for 3 months and then they'll say, "Oops, we were wrong. Those numbers are actually much lower." Uh, I guess if they post the correction, then it's all out there. But I don't know. I have a hard time getting excited about that personally, but there's a lot of chitter chatter about it, so um, it's probably worth covering and keeping an eye on. Luxor highlighted how miners are increasingly monetizing flexible load capacity as AI data centers compete for the same energy. So this means more miners are running behind the meter setups, and they're signing grid service contracts and using curtailment economics to smooth revenue out. Um, just taking a step back, Bitcoin mining is very flexible in terms of its energy usage. It can shut down immediately if there's the need to reroute energy somewhere else, and start up again when needed. AI data centers don't work that way. They need to be 24/7 on all the time, consuming energy. So as miners get into those two businesses, the flexibility of the Bitcoin side of the equation works. Of course, when you're offline, you're not mining and you're not generating revenue either, which is the downside of that. But one thing's for sure, the mining infrastructure definitely overlaps with broader energy markets, and you could certainly see the day coming where Bitcoin mining and AI data center uh, activity kind of merges with power generation. And that kind of becomes like the new business, basically, versus just generating power. With splicing now live in LDK, wallets can resize channels without downtime. So for users, this means fewer failed payments and less manual liquidity management. For merchants, it improves inbound liquidity and makes Lightning more reliable for payments. In case you don't know how setting up a Lightning channel works, you basically uh, s- stake a certain amount of Bitcoin to open your channel, and that records a transaction on chain. And then you process transactions. And then when you close your channel, then the reverse happens, and it gets recorded on chain, and the Bitcoin, is no longer in your wallet. So if you stake, say, 1 Bitcoin, but the volume in your Lightning node is higher than that, in the old days before splicing, you would have to basically your channel would get force closed, and then you'd have to open up a new one with a higher amount of Bitcoin, so you could handle the higher volume. So with splicing, I think it allows you to increase or decrease your channel size without actually closing it, which is really good for people who are managing. Because the other problem with the force close is that um, it could be at a bad time, in terms of you know the market or whatever, and you don't want that to happen. You want to have more control over that as a channel maintainer. So Brazil's Chamber of Deputies held a public hearing on a national Bitcoin reserve bill on August 20th. It's not law yet, but serious enough for formal debate. The question is, as it is in the United States as well, funding. Will they buy Bitcoin directly, mine it, or just use surplus export revenues? Or will they steal it from criminals, which seems to be the favorite way of accumulating Bitcoin from the government? Another sign, though, that nation state Bitcoin reserve discussions are not going away. And so, again, kind of a positive spin on that as it relates to nation state Bitcoin accumulation and game theory. I think currently the United States and China have the most official Bitcoin holdings, um, something like a couple 100,000 Bitcoin-ish each. Um, and then other countries sort of follow, but it's still relatively early, and no country other than El Salvador seems to be consistently accumulating more Bitcoin every day or every week or whatever. Galaxy and other analysts have noted that some long-term holders are moving coins, including, of course, an 80,000 Bitcoin transfer handled by Galaxy recently, which we've talked about before. This is normal in market cycles. Long-term holders remain the dominant cohort, but some coins always circulate, whether it's for liquidity, OTC deals, or rebalancing. This is, of course, a teaching moment. You can't take all-time high hodl waves headlines too seriously. A lot of people are quick to panic and say it's the end of the bull market. And while it might be, um, it's really, there's, as always, half the people you hear from say it is, and the other half say, no, no, we're just getting started. So Uh, does it really matter? Not if you're just accumulating and dollar cost averaging and stacking sats and staying humble. If you're trading, it matters a lot because you don't want to be the guy who buys at the top, hoping to make a quick profit, and then followed by a 50 to 80% drawdown. That's not fun. But there are whales that are selling, and it's creating additional supply, which is fantastic for people that want to buy Bitcoin. And they're doing it for a variety of reasons, estate planning or whatever. Um, and uh, when you think about it too, the majority of the supply of Bitcoin's already been distributed, so it's only a very small amount that's yet to be mined. Most of it is held by individuals, institutions, whoever that is, and they're going to be making decisions and doing things at different times, and so you just have to, I guess, put that all into context when you hear the headlines: "Panic, panic! Whales are selling! Get out now!" kind of stuff. Corporate treasury companies continue to expand, especially in Europe and Asia. Premiums and discounts relative to asset value remain volatile. Um, Again, we've talked about this before and in this podcast. Holding Bitcoin directly avoids governance and leverage risk. But for institutions that can't, these proxies are proliferating. And so, I don't see them going away. Uh, Are they going to crash or crater? Who knows? I mean, obviously, when they're all buying, it's driving the Bitcoin price up. When they all turn into sellers for whatever reason, that'll drive the Bitcoin price down. So, and depending on how big this gets and how frothy it gets, you just have to be prepared for what lies ahead there, and that just means, for me anyway, just put it in cold storage and forget about it. Again, just a quick recap. U.S. miners look for onshore assembly to mitigate tariff costs. That'll be quite interesting to see, and maybe actually a really good thing for U.S. Bitcoin mining, since the government seems to be very much in support of the industry at the moment. Again, courts are showing increasing literacy around key ownership and title, and that's a good thing. But then you need to make sure that you understand that as well and are able to manage that accordingly. Let's take a look at podcast themes across the ecosystem. Uh, there was about four significant themes that came across my radar. The first one being public Bitcoin proxies everywhere. From Amsterdam's Treasury plan to ABTC's NASDAQ listing, podcasters have been debating whether equity wrappers are the future or a distraction. So, no surprise there. Build boring things. Developers talked about fuzzing, splicing, and reliability work, less hype, more real progress. So, again, what's happening quietly in the background is sometimes more important than the headlines. In fact, I would say it's most of the time more important than the headlines, which tend to be a lot of hype sometimes. Infrastructure over apps. So whether it's RGB stablecoins, government data feeds, or lightning remittances, the focus really seems to be on Rails and not on flashy consumer apps. Security and humility. This is kind of the last theme. So, several shows echoed recent crime and phishing stories and reminding listeners that OPSEC matters more than price charts. So, together, these themes show an ecosystem maturing, focusing on reliability, institutional adoption, and security while Bitcoin keeps moving forward. This week's featured Bitcoin Fortress Substack is the Philosophy of Holding, Part 3. So if you haven't read Parts 1 and 2 yet, I encourage you to read the whole series. It's a reflection on why holding Bitcoin matters, what it teaches us about patience, and why sometimes the hardest thing to do is simply nothing. And as always, if you want to get family or friends started on their journey, check out my book, Bitcoin Fortress, A Simple Guide for Beginners. It's available now on Amazon. Again, I'll put links in the show notes. to this week's featured Substack and this week's uh, or and the sorry the book link in the show notes with everything else. And before I wrap up this week, I wanted to share, and this is a preview of an article that's going to be coming out on the Bitcoin Fortress Substack in um, uh, probably a couple weeks. But I wanted to share it here, um, and uh, and since we have some time left, and hopefully enjoy this, and then we will wrap it up. So this is success, failure, and the lessons of Bitcoin. Success and failure are words that carry enormous weight in our society. From a young age, we're taught to seek approval, to chase gold stars, grades, promotions, wealth, or recognition. But when you step back, you start to realize how arbitrary those labels really are. What some call success, others might see as failure, and vice versa. The truth is, neither really matters in the way we've been conditioned to think. Bitcoin teaches us this lesson more clearly than almost anything else. Bitcoin's path, a story of failure before success. If you judge Bitcoin by conventional wisdom in its early days, it was a failure. It was laughed at by mainstream economists, declared dead by journalists hundreds of times, brushed off as a toy for nerds and criminals. For years, almost nobody in positions of influence thought it was worth paying attention to. And yet, here it is, alive and stronger than ever, more than 15 years later. The network has never been hacked. Adoption has spread globally. Institutions, once the harshest critics, now line up to buy it through ETFs. Every cycle, Bitcoin teaches the same humbling truth. The crowd is often wrong, and today's failure can be tomorrow's paradigm shift. Redefining success and failure. One of the most important things Bitcoin shows us is that success and failure aren't single moments. They're chapters in a much larger book. Success is not number go up every day. Failure is not a 70% drawdown in price. Success is persistence. The protocol keeps producing blocks every 10 minutes, whether anyone cheers it on or not. That's a powerful metaphor for our own lives. Your journey is not defined by what the outside world calls failure or success. Those are temporary states, snapshots in time. What matters is whether you keep going, whether you keep mining your own blocks, so to speak. The freedom of not caring what others think. The deeper lesson is this: it doesn't matter what anyone else thinks about your personal journey. Bitcoin has no PR department, no CEO, no one shaping its image for mass approval. It simply exists, serving those who choose to use it. It doesn't need permission, validation, or applause. Imagine living the same way. Imagine not needing the approval of others to feel like you're on the right track. Bitcoin reminds us that truth doesn't require consensus. Reality wins in the end, and even if it's mocked in the beginning. In your own life, the so called failures, projects that didn't work, paths that didn't pan out, are not indictments. They're experiments. They're proof you're moving, learning, and evolving. And no matter how much others might label you, only you can define your path. Conclusion: keep mining your blocks. Success and failure are illusions when seen from the outside. They're only real if you let them define you. Bitcoin's story is a reminder that the world's verdict today is not the world's verdict tomorrow. So keep going, keep building, keep stacking sats in your personal life. And remember, your journey is yours alone. Like Bitcoin, you don't need permission to succeed or anyone else's approval to keep marching forward. And with that, I'll talk to y'all next week. Bye bye.